What if I told you that right now, at this very moment, a single announcement from Beijing is sending shockwaves through commodity markets around the world, causing iron ore prices to spike, and potentially reshaping the entire global steel industry for years to come? What if the decisions being made in China's parliament right now could determine whether construction projects in New York, Sao Paulo, or Sydney become more expensive next year? Well, folks, that is exactly what is happening, and today we are going to break down everything you need to know about this developing story that mainstream media is barely covering. If you find this kind of deep analysis valuable, do me a quick favor, hit that like button, subscribe to the channel, and share this video with someone who cares about global economics, because trust me, this story affects all of us. Let me paint a picture for you. Is early March 2026, and the annual meeting of China's National People's Congress has just wrapped up its most significant session in years. Premier Li Qiang has stepped up to the podium and announced a comprehensive economic plan that has traders on the Dalian Commodity Exchange and the Singapore Exchange scrambling to adjust their positions. Iron ore futures immediately shot up, with the most traded May contract on the Dalian Commodity Exchange climbing 1.27% to 759 yuan per metric ton. That is roughly $110. Meanwhile, on the Singapore Exchange, the benchmark April iron ore contract rose 1.03% to $99.80 per ton. Now, you might be thinking 1 or 2%. That does not sound like much. But in commodity markets where billions of dollars are traded every single day, these movements represent massive shifts in wealth and signal even bigger changes to come. So what exactly did Beijing announce that caused this reaction? Well, first and foremost, China has set an economic growth target of 4.5 to 5% for 2026. Now, this is slightly lower than the 5% growth achieved last year. But here is the thing. It is still within analyst expectations, and more importantly, it signals that Beijing is serious about maintaining economic momentum despite the headwinds they are facing. But the growth target was just the beginning. The real news, the stuff that has commodity traders losing sleep, is the package of measures aimed at stabilizing the real estate market, boosting domestic consumption, and fundamentally restructuring the steel industry. Let me break this down for you, because this is where it gets really interesting. For years, China's property sector was the single largest consumer of steel in the country. We are talking about a market that accounted for roughly 20 to 25% of total fixed asset investment. Construction of apartment buildings, shopping malls, office towers, all of it required massive amounts of steel, which in turn required massive amounts of iron ore. But then came the crisis. Starting around 2021, two of China's biggest property developers, Country Garden and Evergrande, declared bankruptcy after racking up hundreds of billions of dollars in debt. Housing prices have fallen more than 20% since their peak. New home sales in 2024 dropped 14.1% year over year. The sector that once drove Chinese growth became a millstone around the economy's neck. Now here is where it gets fascinating. Beijing has announced a series of measures specifically designed to stabilize this wounded giant. They are talking about improving housing supply, utilizing existing housing stock more efficiently, and even having the government purchase unsold properties to convert them into subsidized housing. They are reforming and improving systems that regulate real estate development, financing, and sales. And they are introducing more targeted policies to stimulate first-time home purchases and household demand for improved housing conditions. The commercial housing market is expected to return to positive growth trajectory in terms of both volume and prices by 2026, according to analysts at China Daily. Rio Tinto, one of the world's largest mining companies, has already indicated that they are seeing signs of stabilization in the Chinese property market. But wait, there is more. Because while they're trying to prop up the property sector, Beijing is simultaneously announcing measures to fundamentally transform the steel industry itself. They are pledging to increase efforts to eliminate outdated production capacity. They are committing to strengthen strategic resource reserves. And perhaps most significantly, they are creating a new mechanism for controlling carbon emissions in the industry, with plans to expand the national carbon emissions trading market between 2026 and 2030. More than 80% of steel capacity in China is expected to complete ultra-low emission upgrades by the end of 2025. This year marks the steel industry's first inclusion in China's national carbon emissions trading scheme. We are witnessing nothing less than a complete restructuring of how the world's largest steel producer operates. Now let me give you some context on why this matters so much for iron ore prices. China is the world's largest steel producer by a massive margin. They produced 960.8 million metric tons last year. To put that in perspective, the next four countries, India, the United States, Japan, and Russia combined produced only 395.4 million metric tons. China alone produces more than twice as much steel as the rest of the top five combined. And here is the crucial part. China does not have enough domestic iron ore to feed this enormous appetite. They import roughly 80% of their iron ore from abroad, primarily from Australia and Brazil. In 2025, China likely achieved record iron ore imports, with monthly imports exceeding 100 million tons for 5 straight months. October alone saw 113.3 million tons coming into Chinese ports, 7% more than the previous year. So when Beijing announces policies that could boost construction activity, support steel-intensive infrastructure projects, and stimulate housing demand, the world listens. Every percentage point increase in Chinese steel demand translates to millions of additional tons of iron ore that needs to be shipped across oceans. Australian mining giants like BHP and Rio Tinto watch these announcements like hawks. Brazilian miner Vale, whose third quarter 2025 production was the highest since 2018, positions its entire strategy around Chinese demand signals. Speaking of Brazil, let me tell you about the record they just broke. In 2025, Brazilian iron ore exports grew 7.1% compared to the previous year, reaching a record 416.4 million metric tons. That is the first time Brazil has ever surpassed 400 million tons in a single year. China remained the dominant buyer, accounting for about 71% of total exports, with shipments to Chinese steel companies increasing 6.4% to 276.79 million tons. The previous record was set back in 2018, before a deadly dam rupture at Vale's operations led to safety reviews that constrained production for years. Now they are back, and they are shipping more iron ore than ever. But here is where the story takes an even more dramatic turn. There is a new player entering the global iron ore market, and it has the potential to completely reshape supply dynamics for decades to come. I am talking about Simandou in Guinea, West Africa. After nearly 3 decades of development, political instability, and shifting ownership, the world's largest untapped deposit of high-grade iron ore has finally come online. On December 2, 2025, the first commercial shipment departed from the newly constructed port of Morbea on Guinea's Atlantic coast. 46 days later, on January 17, 2026, a vessel carrying nearly 200,000 metric tons of iron, or with 65% iron content, arrived at Meijishan Port in Zhejiang Province, China. It was a historic moment. The Simandou project is truly massive in scale. We are talking about a $23 billion investment that includes construction of a 552-kilometer railway linking the mines in the Samanda Mountains to a new deep water port. When fully operational, it will produce up to 120 million metric tons of high-grade iron ore annually. To put that in perspective, that is enough to make Guinea one of the world's top 3 iron ore producers, despite the country not even being in the top 10 today. For China, this is strategic. By diversifying away from their heavy dependence on Australian and Brazilian supply, Beijing gains greater leverage in price and supply negotiations with dominant producers. The project is owned by a combination of Rio Tinto, Chinese state-owned Chinalco, and a Singaporean-Chinese partnership called Winning Consortium Simandou with China Baowu Steel Group, the world's largest steel producer, recently increasing its stake to 51%. Now, some analysts are warning that this new supply could push iron ore prices lower. Internal forecasts from some of the world's largest mining companies suggest prices could fall to $85 per ton over the next 3 years as Simandou reaches full production. Deutsche Bank Research, however, is more optimistic, forecasting prices to average $106 per ton in the first quarter and $102 for 2026 overall, citing a balanced market with bias towards surplus only in the second half. But here is the thing, folks, and this is what I want you to really understand. The iron ore market is not just about simple supply and demand calculations anymore. We are operating in what Deutsche Bank calls a fragmented global operating environment with structurally higher geopolitical volatility. The Trump administration's tariff policies, the ongoing tensions between the United States and China, the shifting alliances and trade barriers being erected around the world, all of these factors are creating uncertainty that paradoxically tends to support commodity prices even when supply increases. Let me give you a concrete example. Chinese steel exports reached 119 million metric tons in 2025, up 15% year-over-year. China increased its share of global steel flow origins from 38% to 42%. But now they are tightening up. Starting in 2026, China is introducing export licenses for a wide range of steel products, covering 245 products compared to just 66 carbon steel products in the previous 2007 version. According to ANZ, total export volumes could drop as much as 30% as China tightens production. This is a massive shift in how steel flows around the world. Meanwhile, while China's overall steel consumption is projected to decline slightly, there are bright spots. Steel consumption in the automotive sector hit 63.9 million tons in 2025, up 10.9% year-over-year, and is projected to reach 66.7 million tons in 2026, representing 4.4% growth. Home appliance steel consumption is estimated at 18.2 million tons in 2025, up 1.7%, with demand forecast to reach 18.9 million tons in 2026. Manufacturing of robots, unmanned factories, expanded port facilities, and rising agricultural automation are all creating what Beijing calls new quality productive forces that will continue driving steel demand even as traditional construction declines. Let me also talk about what is happening outside of China, because the global picture is equally fascinating. The World Steel Association projects global steel demand to stabilize at about 1.749 billion metric tons in 2025, with a modest rebound of 1.3% to 1.773 billion metric tons in 2026. India is emerging as a powerhouse, with steel consumption expected to grow around 9% between 2025 and 2026. Saudi Arabia is ramping up steel demand as part of its Vision 2030 program to diversify the economy away from oil dependence. Vietnam, Egypt, and other developing economies are driving strong growth in the developing world, which is forecast to see demand increase 3.4% in 2025 and 4.7% in 2026, excluding China. And here is something that might surprise you. After years of stagnation, Europe is finally expected to see steel demand growth return. The World Steel Association anticipates what they call the long-awaited return of steel demand growth in Europe. This is significant because European steel markets have been struggling with high energy costs, regulatory pressures, and competition from cheap Chinese imports. If European demand genuinely recovers, it will add another pillar of support for iron ore prices globally. Now let me bring this all together and explain why you should care about this if you are not a commodity trader or mining executive. Everything in the modern world depends on steel. The buildings you work in, the cars you drive, the bridges you cross, the ships that bring goods to your local stores, the wind turbines generating renewable energy, the electric vehicles that are supposed to save the planet, all of them require steel. And steel requires iron ore. When iron ore prices move, it ripples through the entire global economy. If China's stimulus measures succeed in stabilizing the property market and boosting domestic consumption, we could see sustained demand for steel and iron, ore that keeps prices elevated for years. Mining companies in Australia and Brazil would see improved profitability. Shipping companies that transport bulk commodities would benefit. Countries like Guinea that are developing new mining capacity would see economic development accelerate. But consumers around the world might also see higher prices for construction materials, automobiles, and manufactured goods. On the other hand, if China's property market continues its decline despite these measures, if the stimulus fails to generate sustainable demand growth, we could see iron ore prices slide toward the lower projections of $90 per ton or below. Marginal mining operations would come under pressure. Investment in new capacity would slow. And the massive Simandou project that everyone has waited 30 years for might struggle to achieve its potential. The truth is nobody knows exactly how this will play out. What we do know is that the decisions being made in Beijing right now, in the halls of power where China's economic future is being shaped, will have consequences that reach every corner of the globe. The iron ore that will be loaded onto ships in the coming months, from ports in Australia, Brazil, and now Guinea, will eventually become the steel in your next car, your child's school building, or the infrastructure that powers your community. So what should we expect going forward? China's 15 five-year plan for 2026 to 2030 targets urban renewal initiatives, including plans to build and renovate over 700,000 kilometers of underground pipeline networks, requiring new investment of more than 5 trillion yuan. Manufacturing steel consumption is expected to remain solid, even if it cannot fully offset slower construction demand. The real estate sector might see stabilization no earlier than late 2026 or 2027, with some suggesting more direct government intervention may be necessary. For iron ore specifically, the market will remain closely tied to Chinese policy signals. The continued ramp-up of Simandou is the biggest wild card, with production expected to reach 15 to 20 million metric tons in 2026 and 40 to 50 million by 2027. Brazil will continue setting export records as Vale and other producers optimize their operations. Australia will defend its position as the world's largest exporter. And traders around the world will continue watching every statement from Chinese economic officials for hints about future demand. Folks, we are living through a period of unprecedented change in global commodity markets. The old certainties are being challenged. New players are emerging. And the decisions being made today will shape the economic landscape for generations to come. Whether you are an investor trying to position your portfolio, a business owner sourcing raw materials, or simply someone who wants to understand how the world really works, paying attention to what is happening in China's steel and iron ore markets is absolutely essential. I hope this breakdown has given you valuable insight into these complex dynamics. If you learned something new today, please take a moment to hit that subscribe button and ring the notification bell so you do not miss future videos where we continue to explore the stories that matter. Share this video with friends, family, or colleagues who might benefit from this analysis. And drop a comment below telling me what other topics you would like me to cover. The global economy is full of fascinating stories just waiting to be told, and I am here to make sure you understand every single one of them. Thank you for watching, and I will see you in the next video.